Hello, everybody. Welcome back. Happy September. Happy back to school, if you so observe, and happy Bank of Canada Announcement Day. This is our third chat. So I'm here again with Karen Garrett, mortgage specialist with Sea to Sky Mortgages. Welcome back.
Hi,
Last
thank you for having
time,
me.
last time you saw us, we were both on holidays. So we are back home and back to work. And we're here to talk about today's announcement. Last time you predicted that in the next three announcements, we'd have two drops. How are we doing with your prediction?
The Bank of Canada announced today another quarter point drop, and there's more discussion now of the drops in all of the remaining two meetings, potentially a 0.5% in the next meeting in October.
Well, half a point is a big jump. You did mention that the quarter point is common. And I heard rumors this week about the half point. I wasn't sure if that was somebody's wishful thinking. So what would go into deciding that?
The message today from the governor of the Bank of Canada, Tiff Macklem, is that it's a push and pull. They're opposing forces right now. So what's happening is there are signs of the economy weakening. They have to be careful that the economy doesn't weaken too quickly and we go into recession. But there are also some components of the economy that are showing still strong signs of not being affected by inflation. So shelter costs is one. So unfortunately, there's a bit of a push and pull. The message today was definitely a mixed message, but the unemployment rate is higher now. And so that is actually affecting the figures. The government put a lot more money into spending in the second quarter, which then brought those inflation numbers up a bit. So what's happening now is when that settles out after this announcement and this kind of filters into the economy, the idea is that there's room for the Bank of Canada to drop 0.5% and still not bring us into a recession, drop inflation too quickly, is going to encourage spending, but not over encourage spending so that then we don't rise inflation really quickly again and go to the opposite direction of the goal of the 2% target. We're moving in the right direction and there's room for a bigger discount next meeting.
Do you think that the bigger discount in October, would that then maybe affect the first few of 2025? Are we at a risk of affecting that soft landing?
What happens with the Bank of Canada is by the time they do their announcement, they've already predicted where the effects will happen based on their rate changes. So and to say something we addressed a few meetings ago was that most things that happen today don't actually trickle into the economy for up to 2 years. Anything that happens as abruptly as a 0.5 point isn't going to immediately change anything overnight. But where the indicators are changing for us is that the Fed is now announcing that later this month they're going to drop their rates, which is they're having the lowest inflation numbers in the last 3 years. So that is changing some of the direction that world economy is going in, particularly as we're affected a lot by the US. And so they're going to start to drop rates. So there's more room for us to move rates. What that does for 2025 is there was still a prediction that by the end of 2025, we were going to be down 1.75% in our interest rate adjustment, which would be out of the 11 meetings, as 7 of them would be rate drops. So you're probably right in that if they do a more aggressive 0.5 point in one of the earlier meetings, that could slow the changes for next year. But still, the target at the end of 2025 is to be down by 1.75%. So there's room in those meetings to ebb and flow a little bit based on their projections.
Has there been a 0.5 drop before?
Yeah. And in fact, I don't actually have the dates of when the last time a 0.5% dropped, but a long time ago when Quebec was talking about leaving Canada, separating and becoming their own country, there was a 2.5 or a 2.75 drop overnight, one
Whoa.
drop. And then within 10 days of the announcement and not separating, the prime rate moved back. So there typically are quarter point drops. They're not typically higher than that, but there have been instances where 0.5 point is warranted and 0.5 point does happen.
They said this morning that the inflation rate is now the lowest it's been since I think they said March 2021.
Yes, we're at 2.5% now, our inflation rate, which is down obviously from the height of 2022. So we're seeing those numbers slowly come down. We're down from 2.7 in July to now. So we are seeing the inflation numbers dropping, but slowly, which is exactly what you want. You don't want it to fall off a cliff because then everything goes into panic mode and you can either go right into a recession or you can just raise inflation up, which is what happened in the last 2 years because once we came out of COVID, there was a lot of spending, there was a lot of government repayments, there was a lot of people pent up demands, and so people were buying things and spending money, and then obviously the inflation just had to get slowed down and tamped down by raising rates, which is exactly what we just been through.
Can you think of other times historically where we have had those jumps in inflation due to, I mean, this time we're kind of blaming a pandemic. Were there other significant spikes that you can think back on?
Well, the last significant one that comes to mind for me was 2008, 2007, when the US basically went into crisis mode with their mortgages and their backed securities. And so we came out of that less scathed than the US did because our what I was saying earlier, our guidelines and our rules around lending are so much tighter that by 2010 we started to recover from that economy, and by 2011 or 12 we were on the upside of that uh, recession. So probably 2011, 12, 13 in there was when the last time we started to see rates increase, and then they didn't increase to the significance that they have this time since the pandemic, but they were increasing. And if, as someone once said to me, to visualize, imagine going up an elevator, rolling a yo-yo up and down. That's kind of what happens with interest rates. They kind of projectively move up, or they'll, in this case, they're going down, but the yo-yo effect is they'll move up and down within that trajectory. So it's a slow burn either way. When it goes up, it's a slow burn. And when it comes down, it's a slow burn. Coming out of the pandemic, obviously accelerated everything to an unusual limit.
We talk a lot about interest rates with regards to mortgages and inflation rates, but what about other personal debt that is actually affected either directly or indirectly by these interest rates?
An interesting statistic right now is that consumer debt hit $2.5 trillion, which is up 4.2% from this time last year. So we are definitely spending and need to slow down on our spending. And I thought this was interesting. Credit card debt is at $122 billion in credit card debt for Canadians, which makes an average of per person $4,200 on your credit card carrying a balance.
Now, the interest rate doesn't affect credit card, right? They have their rate set.
Not necessarily the rate, but the debt on the credit cards would increase as people can't afford to make payments. So they're expanding what they're borrowing to make ends meet. So instead of buying groceries and paying that off on their next payment, they're actually buying groceries but not paying that debt off. And so that's a result of the fact that interest rates are higher. So your shelter costs and your gas costs and all the other things that have cost on a monthly basis have increased. Your budget can only go so far, so the rest of it's carried on credit cards. So when we say that we're slowly slowing the economy down, there's still a lot of debt that needs to be put back into some form of stability, and that's the push and the pull I was talking about earlier with the government. And you know what, Carmen, what is interesting from a mortgage perspective is that the Bank of Canada and the government and all the different federal ministers seem to pay so much attention to mortgages, yet they don't pay attention to credit card debt. They don't pay attention to car loan debt and how easy it is to get a car loan, how easy it is to get a third and fourth and fifth credit card. But then they give us a hard time as mortgages when somebody needs to refinance the debt to roll it into something more manageable, when the foreclosure rate on properties is like less than 1% and has remained less than 1% for years, because people are less likely to default on where they live over not make their car payments or make their credit card payments or make their loans. But the problem is that the governing body that oversees those debts doesn't seem to have any impact at all when we're being scrutinized. We get the stress test. We have to qualify with ratios that are arguably some of the more stringent in the world. And yet we then can see credit cards be, here's another card in the mail, here's another card in the mail. So it almost
Mm.
feels like somebody on the credit card side, loan side, gets to just say, yeah, run wild, do whatever you want, and then the mortgage side gets penalized on every front. And it's really unfair because, as you mentioned, credit card in the rate has not changed, only because it's 24% or anywhere from 12 to 24% now anyway. It's 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 unbelievable that that is allowed to
Mm.
be a rate. I totally agree with you.
Yeah,
And when you have a credit card, there's some statistic out there that if you have like a $3,000 balance and pay the minimum balance, it'll take you like 22 years to pay that off. It's
mhm.
nuts. No other facility is less monitored than credit card debt. It's crazy.
I can see how that thinking happens because with the threat of losing your house, of course you're going to make that payment. But if a threat is, oh, it's just a bit of interest, and you're not calculating and you're not actually looking at what that means, short term and long term, of course you're going to pay off your mortgage first and like, oh, I can pay that other one later, or
And the other thing too is that when you reach your limits on your credit card, invariably the credit card company doesn't say, hey, slow down, client. They say, hey, we're going to raise your limit. So it's like you keep
yeah.
pushing the envelope as a consumer. And as we do that, then the limits keep increasing. And so suddenly the client's 30, 40, 50,000 in a credit card debt in a downward spiral where now everything is at risk, including their home, because those payments are astronomical now because the interest rate is 3 times the amount of a mortgage payment.
It's a scary place to be in because you can
Yeah.
never get ahead. You can't get ahead. Like
No.
the interest that comes onto the card, and then you have to keep buying your groceries, and all of a sudden you're like, how did I get to where I am now?
But we're so scrutinized as to what we can allow to roll in and what ratios we have and how we qualify a client. Sometimes you can't help a client at that point. So
Mm.
it's really interesting to me as a mortgage person for a long time that they just don't seem to have any governing body overseeing miscellaneous unsecured debt, even, which means, at 19, 18, you can get a credit card, and before you know it, you're two, three, $5,000 in debt, and that can really affect you going forward on your credit rating. It's almost like that keeps the economy going. And
Mm.
if they put a moratorium on easy spending and easy money, access to easy money, that maybe we just go straight into a recession because everyone would stop spending anything. Maybe it's the piece of the cog that keeps the economy going that we don't really pay that much attention to.
As interest rates drop and your main expenses, like your home and your potentially your car, are dropping, does that help then, or do people just spend because they have extra money? I know you've mentioned too, it's not actually a huge difference, like the quarter percent. You mentioned one time it was $16 for
$16.
100,000. It's
Yeah.
not, so it
Yeah.
sounds good.
Yeah.
Um, but is there a brain shift that needs to happen where, okay, we're now saving on the mortgage, we've got to get rid of this other debt? Or is it woohoo, we're saving on our mortgage? More
It's
money.
a combination of both, to be honest. So, for instance, the question can be answered in 2 3 years ago when your mortgage rates were under 2.5%. Did people then opt to then have aggressive payments then, padding their balances for future increases in rates? No. People borrowed whatever they could borrow based on the very lowest interest rates at the time. And so now we're seeing the opposite effect where people are being unable to borrow as much. But that's why the Bank of Canada put that stress test in all those years ago, because they were probably foreseeing that people were going to keep spending. So human nature, I think, in a majority of cases, is if I have access to $400, I'm going to spend 500.
Mm.
And unfortunately, it has to come back to the consumer themselves. and put their own limits on what they spend. And so to answer your question, ideally what you're doing right now is you're cutting back. If you're saving $400 a month now because the interest rates have dropped 3 times and that's essentially money in your pocket, cut back on what you spend, not assume a new debt for $400 worth of payment. It's very hard human nature wise to do that. But if you start to just sort of slowly ease that into your lifestyle, that's where you're going to benefit in the long run, because interest rates aren't going to stay down forever and you need to balance your
Yeah.
budget at any point.
So we'll see you again on October 23rd.
Yep.
Okay, fingers crossed for that one. Thank you so much.
You're welcome, Carmen.
Bye.
Bye.